Get ready to get your questions answered by financial advisors. Learn how to put more money back in your pockets regardless of where you're starting your financial journey with your host, Hannah Mitria. Welcome, everybody, and I'm excited to have Josh Patrick, who is a wealth manager and founding member of Stage 2 Planning, on today to talk to us about business investing and how to prepare your business for the whole financial process. So Josh, give us a little bit of your background and kind of who are the people that you're helping?
Sure. Well, thanks for having me on, first of all. I appreciate that. And I have been hanging around the business world for about 45 years. In 1976, I started my first company when I was 24 years old. I bought a small operation from my father, which was a vending and food service company. We fed people who worked in factories. That over the next 20 years, that grew from one part-time person to 90 full-time employees. Sold that in 1995 and went into the insurance business in 96. And I stayed there for a year and a half before I realized that business owners needed more than life insurance. Mm-hmm. So I opened up a wealth management firm, which started doing full service. We attracted a couple other folks to join the firm. I have been working with people in the blue-collar business world for the last 25 years or so. And our specialty today is we work with people in the construction industry, specifically subcontractors and home builders.
Awesome. And right now with the housing market, I can only imagine there are so many builders out there and they're coming into a lot of money right now too, which, really poses an interesting question of, just what they should be doing. So I'm excited to talk to you today and just kind of learn more of those things that you're sharing with your clients and would advise people on.
Well, the first thing you have to realize when you're talking to business owners is that almost all of them, I don't care what business they're in, has a misconception about what it's going to take for them to become financially independent and retire. If you talk to most business owners who've been in business for 15, 20 years, and you ask them what's the retirement plan, they'll usually kind of hold their arm around the business and say, this is my retirement plan. Mm-hmm. And we have a tool to disabuse them of that fact because it's not the retirement plan. Yeah. We have a tool we call the 4 boxes of financial independence. And the first thing we have to do is teach people that their business is not nearly as worth as much as they think it is. Mm-hmm. And there's 2 reasons for that. One is business owners always overvalue their business. And 2, they never factor in what the cost of taxes and fees are when they sell their business, if they can sell their business. So I give them a little bit of reality about that. So let's just take this for an example. Let's say your business is creating $200,000 in excess cash flow. Mm-hmm. That means after you pay yourself a salary and all the expenses, you have $200,000 left. And let's say you get a really good offer for your business, which is 5 times that $200,000. And by the way, there's an awful lot of businesses in this country that don't even make $200,000 a year. So let's say that they are making $200,000 and they can get $1 million for their business and say, oh boy, $1 million, that's a lot of money. Mm-hmm. Except if they're making $200,000 a year, I can pretty much guarantee they're living on $100,000 a year. Yeah. So that $100,000 will eat into $1 million pretty fast if you had $1 million, but you don't. Because if I sell my business for $1 million, first, I'm going to lose 40% of taxes if you're in an average state that has any income tax. And so you're left with $600,000. And then you probably got $150,000 in fees for accountants, lawyers, brokers, et cetera, to sell your business. So now you're left with about $450,000. Mm-hmm. Now, in the wealth management world, there's what's called the 4% rule, which may or may not work, but it's a good way to have a conversation. So I can say, okay, you can spend 4% a year of that principal that you're left with after taxes and fees. Mm-hmm. So if it's, say, let's just make it $700,000 because I can do the math on that easier. That gives you $28,000 a year to spend. Right. $28,000 is a lot different than $150,000. Mm-hmm. So once I go over that with an owner of a business, I've gotten their attention. Yeah. And they'll often say, okay, smart guy. That's not going to get me there. What do you recommend?
Mm-hmm.
And this is why I think people in the wealth management world need to become experts at understanding qualified retirement plans.
Mm-hmm.
And after I give the owners some bad news and find out they've only saved $250,000 in their simple or 401k plan, I say, well, if you had no limit on saving and you could deduct 100% of what you put into a savings plan, how much would you want to put away a year?
Mm-hmm.
And I've yet to have a business owner tell me more than what they can put away. This conversation typically goes with somebody who's over 50 years old.
Mm-hmm.
And once you're over 50 years old, we have plans and you have less than 25 people in your company, I can guarantee I can put away $200,000 and sometimes $300,000 a year tax deferred. So that business owner is making $200,000 a year is probably not going to be willing to put $200,000 a year away into their plan, but an awful lot of them will say, I want to put away $100,000 a year. Mm-hmm. And I say, okay, so here's the deal. If you save $100,000 a year and you do it taxable, you need to make $180,000 to save $100,000. Mm-hmm. Because you got to pay the taxes before you can save the money.
Yeah.
So the tax cost would be $80,000 to be left with $100,000. You need to make $180 gross. So I said, how would you feel if instead of giving the government $80,000 a year, you gave your employees $25,000 a year? Mm-hmm. Would that work better for you? And I've never had anybody say no. Everyone always says yes. So now if you're 50 years old and you're putting $100,000 a year away, guess what's going to be more valuable for you when you retire?
Your 401k or your retirement plan, right? Your
retirement plan will be worth 3 times what your business is worth. Mm-hmm. So now you've got $2 million in that plan, and that'll give you $80,000 a year. And then you've got, the $25,000 or $35,000 you get to spend off the sale of your business. That gives you $115,000 a year. And you throw Social Security on top of that. Now you're about $150,000. Now we're pretty close to what the owner needs to retire with. And if the owner, and I work with blue collar businesses, it's really easy for them to own the real estate they put their business in. Mm-hmm. They can always rent that, and that's usually worth another $60,000 to $100,000 a year. Okay. So now we're up to about $200,000 a year that the owner gets to spend in retirement versus the $32,000 when we started our conversation.
Yeah, that's dramatically different. And I think a lot of business owners probably don't even think about the 401ks and things like that until maybe you've grown your business, especially as a new business owner or less than 25 people, like you mentioned, just because, I think we think of 401ks when we work in corporate and things like that. And so it's really interesting that you're putting in that perspective for the business owner to do their own retirement plan. And I know you mentioned, typically people over 50 are coming to you at this point. But what is a good time?
You usually don't get a good conversation with a business owner until they're 50 years old about this. Mm-hmm. They're focused on growing their business when they're younger. They're focused on making their business work better. They're making lots and lots of mistakes trying to figure out how to run a business. Mm-hmm. And typically, they're not ready for that conversation until they're about 50. And often they don't get serious about it until they're 60. And at 60, we can put up to $300,000 a year in a plan. Mm-hmm. So, it's a good way to catch up, especially for folks who have built, pretty successful businesses that have a lot of cash flow.
Mm-hmm. Yeah. So do you recommend how, like you said, usually around 50, they start thinking about it, 60, they get serious about it. Is there something you would recommend to, somebody maybe in their 30s or 40s to start taking action for their business?
Well, if you get somebody in their 30s and they put away, if they maximize their 401k payment, they don't have to worry about what their business is worth unless they're spending $400,000 a year, because there's a pretty good chance they'll have $2 to $3 million in their account by the time they get to 65 or 70. The challenge is getting somebody that young to pay enough attention to maximize their 401k. Maybe they'll put $4,000 or $5,000 a year away, but they could get up to $20,000, $25,000 a year. And that is a huge difference. I mean, anybody who's looked at any of the tables, I forgot who said this, is the eighth wonder is compound interest. I forgot who said that, but at any rate, if you start young and you start looking at it, you take $1,000 and you're getting in, let's say, a 10% return. Now, $1,000 becomes $2,000 7 years later, $4,000 14 years later, 28,000 21 years later, 56,000, another 7 years, and then 114. It's not to 30 or 40 years before that one piece of money becomes really something that's significant. But if you're putting away $25,000 a year and you do that for 30 years, you've put away $750,000, which has probably grown to $2.5 to $3 million over that time period. Now, if you can get somebody young to start doing that, it's a huge, huge benefit for them when they get to retirement. The challenge becomes getting someone's attention who owns a business, is focused on growing their business and making their business work. And at 30 years old, often they may say, well, my business is going to be worth $5 to $10 million, so I don't need to worry about this. There are very, very, very few businesses that ever get to $5 to $10 million in value. And just think about this for a second. There's 28 million businesses in the United States. 6 million of those businesses have any employees at all. Only 300,000 of those businesses ever grow to $5 million in sales, and only 150,000 grow to $10 million in sales. And if you think you're going to retire on your business by itself, you need to have a business doing at least $10 million in sales. So that's such a small percentage that the chances of you getting there is almost as small as a high school basketball player making it in the NBA.
Yeah. They say so many, half of businesses fail before they even get going, just because, owning a business is not an easy thing. You own many, so you understand and you help so many people with businesses. So I think it's good. I think more people should be looking at this early. They shouldn't be waiting until they're in their 50s and 60s. And, as part of the reason of this podcast, even, is me and my husband started going to financial advisors, and we are both young, but, we're like, holy crap, this, there's so much we need to be doing and we don't realize it. And so I think it's really great to hear how, if we started investing now, where we could be when we retire, because we don't think about that, but we all want to have that time where we can just enjoy life and not have to work and be busy and things like that.
Yeah, well, we don't think about, human beings are not very good at long-range planning as a rule. There are exceptions to that, but most people live their life and they don't really ever sit down with a pencil and paper and figure out how much they need to be saving or how they need to be saving and how they can do that. One of the easy ways to do it is, if you're an employee, you just manage how you work. So if you change your job and you get a 20% raise, you can only spend 10%. The other 10% needs to go into a savings account. And every time you get a raise, if you take half your raise and you save it, you're going to be very wealthy by the time you get to retirement.
Yeah, definitely.
And it's an easy strategy to do. It's not very hard, but not many people hire or talk to a financial advisor, a financial planner to help them figure that stuff out.
I wanted to jump a little bit to a different gear of just, today's market and where we're in. And I think a lot of people get scared of, they're seeing inflation, things like that. So what are some challenges that come with, planning your retirement now when we're dealing with some of these, the recession that could potentially be, in our hands right now in a down market? So what are some challenges you see facing there whenever people, business owners specifically, are trying to plan retirement?
Well, I'll say the same thing to a business owner I would say to anybody, which is stop watching what happens in the stock market day to day, because it doesn't matter. If you're 40, 50, even 60 years old, you're not going to use your money for 10, 15 years. It doesn't matter that the market's going down today. In fact, you're buying stock cheaper when it goes down if you have regular investing. So every paycheck, you take whatever it is you do on an annual basis, and you put it away. That's called dollar cost averaging. You're buying stock when it's low and you're buying stock when it's high, but the average comes out over the long term, the stock market goes up. In the short term, it can go down. We have 20% drops in the stock market on a relatively regular basis. It's, for the past 10 years, it's been sort of like to say, well, it's only going in one direction. Well, that doesn't always happen. Now we've seen the reality of that. But the truth is, I've tried all sorts of fancy investing strategies where I'm trying to beat the market or I'm trying to beat the market down. The only strategy I've seen really work, and this is just my own preference, people can argue with me, is we do one of two strategies. We either buy a well-allocated basket of either index funds or exchange-traded funds, or for the stock portion of our investment, we use dividend growth, which means you're buying dividend-paying stocks, and you only hold them if the dividends are growing. As soon as the dividend gets cut, you sell the stock. It's a pretty simple way to do it. And the people don't realize, but dividends are a very significant portion of long-term return for people who are buy and hold investors. And the truth is, I have never seen a strategy that works better than buy and hold over a long period of time. I've seen all sorts of strategies that come my way where, boy, it looks awfully good in the short term. And every time I went into them, whatever they were doing stopped working, and they underperformed the market, not by a little bit, by a dramatic amount. So if you're in the accumulation phase, which means you're saving for retirement, and retirement is more than 10 years away, you can actually be mostly in the stock market. You might keep some cash for emergencies and bonds for longer term emergencies, but frankly, you should be mostly in the stock market because it's the only thing that beats inflation over the long term.
Awesome. No, that's great advice. And just, hearing about the dividends and, making sure that you're looking at those kind of stocks, especially if you're holding them long. But like you said, if you're not retiring for 10 to 15 years, being in the stock market, and it is always going to go up and down. There's no doubt about that. That's what the stock market does for sure.
Yeah, the stock market goes up and the stock market goes down. But now if you're at retirement or you're close to retirement, we use a different strategy. Because now if the market goes down significantly, that could really make a bad day for you. So in that case, what we ask people to do is say, okay, how much do you need in cash every year? So let's say, after Social Security, you need $60,000 a year. So then we're going to take $180,000 and going to put it into a money market. And we're going to leave it there. We don't care if it doesn't get a return. It's there for an emergency. We then take the next 6 or 7 years of money that you need, and we put that into a bond account of some sort. And again, bonds are less volatile than stocks, but they're not less volatile than cash. But that gives you 10 years of bonds and stocks that are put aside for you. Everything else we put in stocks because we've not ever had a 10-year period since the 20s where stocks have been down over a 10-year period. So it doesn't matter if the market goes down by 30% because you're not spending that money. We're going to take the money out of cash. We'll take the money out of bonds. And then by the time we actually need to reallocate, there's a pretty darn good chance the stock market has gone up. It's not a guarantee, but it's surely been a really good way of investing and a safe way to do it over a long period of time where you're limiting the risk that you take.
Awesome. No, I think that is so smart, and to be diversifying that way and be looking at it. And I think a lot of people, especially when they start investing, they think everything's going to go in one spot, but to look at it as what do I need today and what do I need in 10 years and be able to push them in the ways that make the most sense so that if you need it in a year, you can get that money out and not worry about that. So, and I know you mentioned, we're going to jump back to earlier, you mentioned how you go with, the 4 box of financial independence. And I know you mentioned that, one thing is most people are overanalyzing and then tax and fees. Can you kind of go through those 4 boxes with us a little bit more?
Sure. Box 1 is your business. What's the after-tax value of your business? Taking 4% of that, what's the cash flow that will create? Box 2 is your qualified plan. If you put away this much money and you get a reasonable amount of return on it over X amount of years, what does that grow to? And then you take 4% of that and you can spend that. And then the box 3 is investment real estate that you might have. And for a business owner, many of them own the real estate that they operate their business out of. Now, when they sell their business or they close their business or move on, they don't have to sell the real estate. They can keep it. And if they've been in business for 20, 25 years, the real estate's probably paid off. They do what's called a triple net lease, which is they get paid rent and the lessor pays all the expenses of the building. They get to keep that. That's often more valuable on a cash flow basis than a retirement plan or the value of the business. And then the fourth box is other investments that you may save outside of a qualified plan over the years. Now, I only need to usually fill the first three boxes. Mm-hmm. And the fourth box is a bonus box. Rarely do we have to fill that to get somebody to be financially independent. Mm-hmm. But if you pay attention to those first three boxes, we did that example before, $1 million business, worth about $35,000 in cash flow, qualified plan worth about $80,000 in cash flow, real estate worth $60,000 to $100,000 a year. That gets you to a couple $100,000 a year, which is about more than what most business owners make running their businesses. Now, there are business owners that make a lot more than that, and there are business owners that make a lot less than that. Mm-hmm. But, you say the majority, there aren't many business owners that make more than $200,000 a year they pull out of their business.
Awesome. Thank you for that, because I just want to make sure I had all four of them down there. I had the taxes and fees and qualified plans. And like you said, real estate planning and then just knowing your business evaluation really is real estate itself. And you work in construction, I know, is a huge part of many investment plans on there. So my last question for you on just like business planning and investing is, what is your best tip for the planning process for an independent business owner?
Find a planner that knows how to plan for business owners. Most planners are terrible when it comes to planning for business owners. And the mistakes I see most planners make is, one, they accept the value that the business owner tells them the business is worth without challenging that. So you got to learn how to do some back of the envelope business valuations. You can pay $10,000 to have a formal valuation done, or I can do it for you in 5 minutes by asking you 5 or 6 questions. Mm-hmm. It won't be $10,000. So you get a rough idea of what your business is worth. And the easiest thing to do to improve your situation is make your business worth more, or have your business have more cash flow so you can invest more of it into a qualified plan or buy real estate or move money outside the business so it becomes even more valuable for you. Your business should be a cash generating machine, not an asset providing machine at the end of the day. Mm-hmm. So I always tell business owners, I say, I want you to think about pre-funding your retirement, which means you take the cash flow of the business, you carve off a significant portion of it, and instead of reinvesting in the business, you invest it outside. Now, reinvesting in your business will get you a better return. Mm-hmm. But if your business is good and you know how to use a bank and you know how to use leverage, you can probably grow your business pretty darn quickly using the money that you don't put into a qualified plan, the other $100,000 or so in your business, and you can leverage that at usually an 80% level. So in other words, if I go to a bank and say, okay, I want to borrow $500,000 from you, the bank will say, if you have a good business, great. Do you have $100,000 to put in? And if you do, the bank will say, okay, we'll loan you $300,000 to $400,000 on that. Mm-hmm. So you're using leverage, using other people's money to grow your business. It's the cheapest way to grow a business. Mm-hmm. So if you make your business better, that's one thing you can do. If you use your bank as leverage to grow your business, you can do that. But putting every dollar back into the business isn't going to get you to where you want to go. Now, I've had people for years when I had my food service company come in and say, you need to diversify your business for safety. Mm-hmm. And I used to say, yeah, right. And which was like, are you kidding me? Mm-hmm. I know more about this business than what you're doing, so I'm not going to diversify just because you say I need to for safety. Mm-hmm. But when I show people they have to diversify if they want to retire, then I get their attention.
Mm-hmm. Awesome. I think, just finding ways to use money, like you said, going and leveraging that so that you're not spending your money to grow your business, but then creating that money through your business, I think are great ways to create that cash generating machine, like you mentioned. And, just like you started with, finding a planner for your business. I've talked to many financial advisors, and honestly, at the beginning, a lot of them didn't really want to talk to business owners. And I'm really glad that you do want to talk to business owners. And so
there was a reason to want to talk to business owners, because business owners are no BS people. Mm-hmm. And most financial advisors come with a line of BS, mm-hmm. and they get taken apart by the business owner because they have no patience for that. Mm-hmm. If you understand the mindset of a business owner, they're easy to work with. And the other thing is, stop pitching and start asking questions. Mm-hmm. I mean, I remember, when I would have my food service company, I'd have life insurance guys come in and try to sell me what was called split dollar insurance. And I would always say to them, I say, now let me get this straight. I own the business, right? And they said, yup. Mm-hmm. I said, and you want me to do this insurance thing, which will have a low tax effect today, but a big tax effect tomorrow, to tie me down to my own business. Now, why is that a good idea?
Doesn't sound like it.
No, I mean, and this is why financial advisors are intimidated by business owners, because they tend to be no BS people. They won't sit there and listen to you kindly, shake their head and say, oh, yeah, okay, fine. They'll probably say, I'll think about it, which means go away, I'll never talk to you again.
Yes, definitely. So what are some questions that people should be asking a financial advisor to really make sure they understand what business is? A business owner is like, I need to invest in somebody. What questions should they be asking a financial advisor or planner before they would hire them or anything like that?
Well, they should be asking what their investment strategy is and why it makes sense. They should be asking all sorts of why questions. Why should I do this? How will this make my life better? What are you going to tell me, or what are you going to do for me that the other folks can't do or won't do? Mm-hmm. You should be very wary of any financial advisor or wealth manager or financial planner that comes in and says, I'm going to get you returns that beat the market by 3 or 4% a year. It's almost impossible to do. I mean, in fact, it's if you look at, actively managed mutual funds that are in the top of the Morningstar 5-star list, 5 years later, there's a pretty good chance they're going to be in the bottom half. So if an advisor comes in and it sounds too good to be true, it's probably too good to be true. If you have questions, you say, where's your references? Mm-hmm. Who should I talk to who's worked with you? What's the feeling that you get from the person when you talk to them? Do you feel like you can trust them? So there's, I have this thing we call the trust formula that we use all the time. And it essentially is really 4 pieces. It's competence plus reliability plus intimacy, which means how much I care about you, divided by self-interest. So when I'm looking at somebody I'm going to hire, I want to know, are they competent in what they do? And how would I know that? Mm-hmm. 2, do they care about me as a person? And how do I know they care about me as a person? And 3, do they do what they say they're going to do when they said they're going to do it? So I always test people on that. And then finally say, is this in their best interest? Or is it in my best interest? Or are we someplace in the middle? Mm-hmm. One of the reasons I'm a big fan of financial advisors who are fee only is it's really not, as a customer, you don't have to worry about, is he pushing it or she pushing this product because they get a big commission on it or they make more money on it. Mm-hmm. If I'm doing fee only and I charge you, 1 point or 0.75% for a fee, it doesn't matter what I recommend to you, my fee is the same. Mm-hmm. So it's to my benefit to recommend the very best thing I can that's in your interest. Also, if you're working with a fee-only financial advisor, by law, they're a fiduciary. Mm-hmm. A broker is not. The fiduciary means I have to put your interest in front of my interest, and I legally have to do that. Mm-hmm. So if I'm working with an advisor, I want to make sure that they're fee only. I probably want them to be a CFP or something that's equivalent to a CFP, which is a certified financial planner. Mm-hmm. I don't think you should work with investment advisors. I think you should work with financial planners. Mm-hmm. It's not the plan that's important. It's the planning process that's important. So if a planner comes in and says, I want to do a plan to give you this 100-page plan, and they don't have a methodology for continuing planning as time goes on, what good are they? Because the truth is, if I give you a financial plan, it's wrong before I even put it through my printer. Because a very small change in interest rates means that the plan is out of whack. It's going to be either better or worse, but not what you're thinking.
Yeah.
And as life goes on, I mean, here's what happens. If I'm making $100,000 a year, I'll spend that money. If I'm making $200,000 a year, I'll spend that money. Now, if I'm making $200,000 a year, I better have a strategy that gets me $200,000 a year in retirement. And that's planning. It's not a plan. Because as life goes on, things change. You get sick, you have kids, they go to college, you have parents that might get sick or need extra help. You might need extra help. There's a zillion things that happen along the way that are part of a planning process. Now, if you own a business, you really need to do this because not only do you need to be planning for yourself, you need to be planning for your business. And if you don't do scenario planning for your business, there's a pretty good chance at some point you're going to have a really bad day that you may not be able to recover from.
Awesome. Well, that was a ton of information to be able to help us really figure out who we should be talking to. So thank you for that, Josh. And now tell people, how can they reach out to you? And so if they're a business owner and they're like, I need you to be my financial planner, my wealth manager, how can they connect with you? How can they work with you?
Well, it's really easy to find me. You just go to jpatrick@stage2planning.com. That's the number 2. Or you could go to one of our websites, which is www.stage2planning.com. That's our wealth management website. And my business consulting business is at www.sustainablebusiness.co. That's .co, not .com. And if you want to get my newsletter, just go to www.sustainablebusiness.co/newsletter. Give me your first name and email address. And every Tuesday morning at 9 o'clock East Coast time, out comes my newsletter. I've been doing it for 45 years, starting on a mimeograph machine, if you knew what that was, back 45 years ago.
Okay, I know you have like 300 podcasts out, over 300 episodes.
Yeah, 360 some odd episodes of podcasts, over 1,000 blog posts, over 150 videos. So we put out a lot of content.
Awesome. Yep. So if you are a business owner and you're looking to, plan for the future, make sure you reach out to Josh. We'll make sure to have all of those links for you also in the show notes of this episode. And then Josh, is there a certain stage where they should be reaching out to you at? Like, what is that perfect moment for them?
Anytime they're thinking about going through any sort of a transition.
Perfect. All right. Well, thank you, Josh, so much for being on, and we'll get that stuff out there for them to find your website for, wealth management, as well as sustainablebusiness.co.com so they can reach out to you there and get your newsletter. Thank you so much for being on the Virtual U.S. Financial Advisor podcast.
My pleasure. Thanks so much for having me.
Thank you for joining us this week on the Virtual U.S. Financial Advisor podcast. Subscribe to the show on Apple Podcasts, Spotify, Stitcher, or via RSS so you'll never miss an episode. We'd love a rating on iTunes, or better yet, tell a friend about the show, which will help us grow as well. If you want to learn from any of our financial advisors, head over to our website, virtualusfinancialadvisor.com, to learn more about each financial advisor and connect with them personally. Be sure to tune in next week to get more advice from the expert financial advisors. See you on the next episode.